Hey everybody, today is Sunday, July 14th, 2019. We're taking a look at the S&P 500 as we get ready to trade July week 3 and monthly OPEX week for the S&P 500 and the rest of the broader market. Anyway, we're also going to be starting into earnings season this week as well when JPM kicks off reporting on Tuesday morning before the bell. So this is our S&P 500 roadmap chart, the more complex daily chart that I post for you guys every morning. Here we can see that we traded on Friday up to a new all-time high and a new all-time closing high at 3013. We knew this was coming our way as of Thursday's close because on Thursday we finally made a new all-time closing high over the one that we had made back here on July 3rd. This was a nice big trend day leading into the 4th of July holiday. We made our all-time high and our all-time closing high. Then we came back after the holiday, we made a lower high, and we sold off. We sold off down to a back test and hold well above the July open and low for the quarter and for Q3 at 29.52. We tested into our 29.64 handle, which has been a point of support and resistance for us on the way up. And we tested the 10-day simple moving average, found buyers, we turned around, and we've made this new run here that took us up to 3013.92. And from our list of targets that we have been using, we had our next two targets at 3013 or 3012, and here are two different sets of ideas of what could be our points that we're rolling off of and and making highs off of. One idea is the idea that we're coming we're making moves above the previous all-time high that we had made on the first trading day of May, from where we sold off all the way down to 27.28. That's why this 29.54 level is important. And then also the idea of percentage points off of that June low that we made at 27.28. So now the 30.12 came from a double up from that June low to the takeout of the 50-day. Check, we've taken that out. Plus 2% on a takeout of the May high. Check, we've taken that out. If we were to move on to the next two target points on this list, we would get either to 30.43 for plus 3% on that. And of course, we could just do plus 2.5%, whatever. I'm just trying to keep it simple here. You get the idea that somewhere between 30.13 and 30.43 is taking us from 2% to 3% up off of the takeout of that previous all-time high. If we were to get to 30.55, it would be times 2 from that June low to the takeout of 28.92. 28.92 was a really tough level that we had to gap up open to take out on the way up off of the June low. It had been a big gap that we had left on the way down from that May high. 30.55 is also a nice clean 100 points on top of our July low that we've made coming into this new quarter and new month. And the market loves to do that as well, make nice little 100-point rallies on the S&P, sort of assess where things are at and then maybe pull back from there or maybe go on and keep tacking onto it. So there's some supporting motivation behind trying to get to 30.55 as well. What's coming our way this week as far as data is concerned and things happening in the market? The main thing that has changed up for this week was that the Mueller testimony was postponed 1 week. Isn't that convenient? Here we are in the middle of OPEX week, and on Wednesday is usually sort of like the big culminating day. It's really only retail that's still messing around with the monthly options on Thursday because they expire on Friday open. Frankly, this whole week is probably more about retail and more of the riskier players that are trying to set things up in the market. Probably a lot of stuff was consolidated and taken care of into Friday's close. But in any case, that Mueller testimony was going to be smack dab in the middle of our OPEX week. That's been moved out 1 week conveniently to the following Wednesday, to the 24th. I'm going to be off that week. But if anything big happens regarding what's going on that day, I'll tweet about it. But if not, you guys have your target list. You guys have the roadmap and all that stuff. I'm not even going to have my laptop this week, so I can't even post updated charts for you guys anyway. So hopefully you've learned plenty of stuff to get you through this 1 week that I've taken off. This is the only week I've taken off since reopening the private room. So hopefully this won't end up being the worst choice of weeks in the history of taking vacation. Anyway, because also on the day that Mueller testifies, we have Boeing and Cat in pre-market, and then Facebook after hours. So it's probably going to be a pretty big day. Anyway, that's that. What's going on this week right in front of us is starting tonight. We have China GDP data coming out overnight. That's obviously going to be a market mover of some sort. So if futures are doing some wild stuff overnight, it probably has to do with the China GDP numbers. Monday is Amazon Prime Day. That could be a potential, bullish market mover of a day. Could lift the entire FANG complex. And then we have before the open, we have New York Empire manufacturing data. Any kind of manufacturing data right now is going to be extremely important to the market because the market is looking to see if the cracks are showing that we're possibly slipping into recession. Because around the world, we're seeing manufacturing data drop off from China, from Europe, from everywhere. On Tuesday, we have JP Morgan reporting before the bell. And retail sales data before the bell as well. JP Morgan earnings will come out around 7:30 Eastern time, and then the retail sales data is an hour later at 8:30 Eastern time. On Wednesday, we have Netflix and IBM after the bell, but during the day, we will have housing starts in the pre-market, and then the Fed beige book at 2 o'clock in the afternoon. So this is going to be one of those days where we get this big speed bump in the middle of the day, not just because of Wednesday OPEX, but also because of the beige book. And then, maybe it'll be a slow day. And then after 2 o'clock, after we get to see the Fed beige book, then we move on and start anticipating Netflix and IBM reporting after the bell. Then on Thursday, we will trade the fallout of whatever has happened from Netflix and IBM reporting. And we will have weekly jobless claims and another manufacturing index, the Philly Fed manufacturing index. So if we had any kind of a big move on Monday, we'll see something happen again similar to that on Thursday off of a similar type of data point. And then on Friday, it's monthly OPEX, so options are going to expire with whatever the average opening print is on the S&P 500 using the ticker set. That's how we figure out what monthly settlement is going to be. And then Bullard of the Fed is going to be speaking at some point during the day on Friday. So that's what's going on there. Let's take a look at our little bit more backed out chart and talk about what could happen further to the downside. And what concerns me right now is that if we do get into a sell-off, is how far stretched apart simple moving averages are. And if we come down and all we do on our sell-offs from here on out until, marking the end of the rally, if all we do is test and hold above the 10-day simple moving average, that's fine. And you can see how that has pretty much worked going all the way back here, all the way to June 14th, I should say. That has worked well for us. But if we were to lose the 10-day simple moving average, it's quite a bit of a fall to get to the 20-day. But right now, the 10-day is rising up, and it's coming right into line with these lows that we made last week, where we almost went bearish engulfing. So maybe this is a line of protection that we are going to be holding. And if so, we're not going to be breaking down below 29.80 or so. If we do break the 10-day, it's a bit of a fall to get to the 20-day. But here you see the 20-day is rising up over an important point. It's rising up just over the July low. So for all intents and purposes, if we were to pull back all the way to the 20-day, we would still make a nice hold above the July low. We would hold our 29.50 handle. That rhymes with our 80 handle rule of pulling back from a look above 3,000, holding above 29.50, and working our way back through the 29.60s, the 29.80s, and back above 3,000 again. But here's where the problem comes in. If we get down and we break below the 20-day simple moving average, it's quite a drop to get down to the 50-day from there. And that is almost always, you can look back through any daily chart on any security that you want to. It's not just the S&P 500, but once you lose the 10-day, the 20-day, it's almost always, a process. But the end game is going to wind up being most likely to move all the way to the 50-day. And we have all these gaps. Look at all these big purple bars. These are all gaps, and especially this gigantic one here. This is the one that we're judging. This gap is the one that we're judging one of our target numbers from to begin with. That 28.92 level. So what we want to see is that if we do lose that 20-day simple moving average, we want to just be pair that we could fall all the way back here to the 50-day simple moving average and fill this gap in, or at least look into this gap here. So watch where these simple moving averages are. Keep track of where those are at. What I do is I remark them on my 5-minute chart every morning when I see what they are off of the open. One final thing that we can also use to help us figure out what's going on is an ES chart. This is an hourly ES chart, and you can see this green line is where the new contract began trading, where we rolled over into the new contract on the 13th. And you can see that we are in a clearly defined up channel here on using the hourly time frame. You can see, and as long as we stay within this channel and keep grinding higher, we are in a defined uptrend that helps us figure out when maybe things are going to run out of gas, and also what needs to hold support down below. And when we look into this a little closer using a 15-minute version of this same exact chart, we can see that right now, right as we come out of the gate Sunday, the top of this channel is marked off at 30.41. So as the hours wear on, we get towards that 30.43 next target for S&P. There is a 3.5 to 3.75 so far spread with ES. So anything ES is doing, you subtract off 3.5 to 3.75 points, and you'll get your equivalent S&P level until either time or a major volatility swing changes that spread. That's what changes the spread. The spread gets narrower and narrower as we get closer to contract expiration, but sometimes the spread changes when we have a really big volatile move up or down. Okay, so that's where the top of the channel is. The bottom of the channel right now is moving towards the 2970s. Okay, so as the week wears on and this bottom of this channel rises over 2980, that helps protect us inside of our 80 handle rule on the S&P 500. So you can easily draw this channel for yourself. I will post both the hourly and the 15-minute view of this channel, so you can sort of make this for yourself if you watch or trade ES as well with your S&P 500. That'll help you out. Okay, that's it for the weekend video. I hope this helped you kind of figure out where things are at, where things can possibly go. Just keep following our target list. If we get into a pullback, we want to start using those percentages of a pullback from our all-time high and start looking at that and seeing if they line up to things on our roadmap. That sort of gives us an idea of, where we could possibly be targeting. And then we also, want to intermingle in there, of course, our simple moving averages where they are at. All right, have a good rest of your day, and good luck and good trading.